Good afternoon, everyone. My name is Adit Kapoor. I'm the product specialist for ICICI Prudential Mutual Funds. Welcome you all on this con call for ICICI Prudential Mutual Fund on market outlook and way forward. Every time we have seen there are different challenges and opportunities in the market. To understand the market dynamics in the current situation, we have Mr. Shankaran Naren, our Chief Investment Officer and Executive Director. He has no introduction today. He is one of the top fund managers in the country. He will be discussing what are the opportunities and strategies which can be used in the current market situation. Over to you, Naren, without any further ado.
Welcome to all of you. Thank you for participating on a Saturday morning. 2020, the market had tanked due to COVID and the valuations had become very attractive. So it was a very easy opportunity for people to increase equity, and we had made a lot of efforts at that point of time. Also through launches of funds like Business Cycle, FlexiCap, ESG, and housing and various things at that point of time. So then the markets became overvalued, and also, frankly, we knew that globally interest rates were on their way up. And we thought there would be meaningful corrections. Frankly, the corrections did not happen because domestic investors were pretty positive and they cushioned the corrections. Markets did not take off but did not correct. And because bulk of the selling of FIIs in 2021-22 got absorbed by locals, and bulk of the selling at that point of time was in large caps. And the selling got absorbed by the domestics. So mid and small caps started to outperform. And we realized that from that point onwards, frankly, we have been in a camp which is where we have been more confused, unlike 2020-21. And we have actually talked more on asset allocation. And we have found that to be a easier way to invest, given that valuation was not comfortable. In the 2023 budget, what happened was that debt taxation was increased to marginal in mutual funds, and consequent to that, our interest in doing asset allocation became even more positive, and we became more and more positive on asset allocation, and equity valuation kept on going up. And it was a very difficult time to explain to people why is it that every month the equity market is going up and valuation is just shooting up every month. So, this was primarily because of the fact that most investors in India did not like any other asset class other than equities. And they decided that they'll keep on investing in equities. Of course, we recommended hybrid and asset allocation strategies, which also did very well, albeit little bit less than equities, but nevertheless gave very good absolute returns. So although the valuations kept on expanding over this space, and we continue to recommend asset allocation as the way forward in this entire period. Slowly, domestic sentiment went into a crescendo, and you had a situation where loss-making companies could raise money in equity market, and even young companies could raise money in equity market. And we continued to recommend asset allocation, and there was nothing we could do because end of the day, every month markets went up, and the crescendo in domestic sentiment continued to be very high. And you had a situation where companies with huge losses could raise money in equity markets without any problems, actually. So it was a tough phase for rational investing, and that was the reality. So when the US election happened and dollar started appreciating, what the FIs realized was Indian equity markets was meaningfully overvalued. And they had huge profits in India, and dollar was continuously appreciating. So it was not that there was a problem in Indian fundamentals per se. There was nothing wrong with Indian fundamentals, whether it was in the banking system or in the corporate sector or in the economy. But they had huge profits in India. So they decided, let's sell 1 to 1.5% of our holdings, which is not small, which itself comes to 1 lakh crores. So they sold that and took the money back. And it was nothing to do with Indian fundamentals. It was to do with Indian valuations and the need for them to take the money back home because dollar was appreciating. So that was the reason for this fall. Again, the selling happened only in mega cap and large cap because bulk of their holding, which is there, and frankly, if you look at it, they have a holding of 800, $900 billion, but bulk of their holding is in large cap and mega cap, not in small cap and micro cap. So that's why the selling also was primarily in large cap and mega cap. So as we have a framework which is very simple actually. We look at valuations, we look at where we are in the cycle, we look at what is the sentiment, and we look at outlook. Sentiment is something which we look at in a very interesting way, where, if you go back and think, sentiment is something for long-term investors, you have to look inverse. So in 2001, no one was investing in equity in India. 2001 too. No foreigner was also investing in India. No retail investor was also investing. So that was the best time to invest. On the other hand, 2007 was a year where FIs were also investing in India. Local mutual funds were also investing. Direct equity was also, people were investing. So that was unsafe. On the other hand, 2008 post-Lehman, FIs were selling aggressively. Retail investors and local investors stopped selling, but they didn't also invest. So that was a good time. 2020 was a period where again FIs sold aggressively. Locals just did not buy, and retail investor mutual funds did not also sell, but they did not buy much. So we use sentiment as as an opposite indicator, which means that if people are buying aggressively, be negative. If people are selling aggressively, be positive. So now, after a long time, the sentiment indicator became clearly more positive on large caps because the FIs were selling at a very, very big pace recently. And although domestics are not selling, they are buying, at least the selling by FIs were huge. So the sentiment indicator for large cap became, I would say, positive, and mega cap became positive. And on the other hand, the sentiment indicator for mid cap and small cap continued to be negative because FIs are not selling, locals are not selling, retail is not selling. So that indicator continued to be negative. So we are in a situation where large caps have become reasonably attractive on the sentiment indicator. Mega caps have become reasonably attractive on the sentiment indicator. But on valuations, we are not dirt cheap yet. I would be very happy if valuations were also dirt cheap, but they are not dirt cheap like 2020 or something. But at least the sentiment indicator is positive. So that is where we are at this point of time. So, periodically as part of our job, what we do is we think what are the kind of categories that we can launch at a point of time. So we did approach the regulator, and the regulator gave us a permission to launch a fund called Minimum Variance Fund, which is a pure mega cap and large cap fund, which was based on Nifty. Do we see a problem in the economy? The answer is no. Do we see a problem in the banking system? Answer is no. Do we see a problem in the corporate sector? The answer is no. Do we see very, very cheap valuation? The answer is no. So when we saw a situation where large caps and mega caps are more reasonable, and the companies and the fund that we have got, the minimum variance fund, is something like participating in more defensive segments of the market. And in the mega cap and large cap space, it was exactly in tune with where we think outside asset allocation, within equity where we would want to be. And that is why we were very happy in launching the ICICI Prudential Minimum Variance Fund, because it was in line with what what is the area that we would want investors to invest in at this point of time. What would we have been happier with if the market was even lower, but market can't be lower easily because their fundamentals are reasonable and markets have corrected. So, yes, is there potential for more correction if FIs sell more? Answer is yes. Can we predict that FIs will sell more? Answer is no. If you look at the last few weeks itself, the selling has actually slowed down. So that is what we see at this point of time. And we thought it's an interesting category. Mega cap, large cap, more defensive kind of large cap areas. The name is a bit daunting. What minimum variance means is you pick up stocks, you create a category where you invest in more defensive kind of stocks. So if you are, for example, thinking that the market will give very high returns, I think it's not the fund for you. If you're a person who believes that market is going to give huge negative returns, it's not a fund for you. So it is not the fund for people who believe either in mega returns or people who believe in negative returns. And that is why actually it fits in with a model which is closer to our framework of thinking of asset allocation. And that is why it was something which we were comfortable launching in a volatile market like what we've seen in the recent past. And that was the framework behind launching of this strategy. And it's, as such, do we believe in the next 2 to 3 years will FIs come back to India? The answer is yes. The day the dollar strength thesis breaks, I think India will see flows. Will dollar strength thesis break? The answer is yes. Because if you look at the US economy, you have a situation where the current account deficit is very high, fiscal deficit is very high, even inflation is not low. So when you have a situation where current account deficit and fiscal deficit is high and inflation is not low, you're not going to have a situation where the currency only appreciates. And we have seen that when I've seen most countries in the world, when you have high fiscal and high current account, at some stage the currency cannot keep on appreciating, even if it is the reserve currency of the world. So that's why we are not really worried. Of course, we cannot predict when FIs come back in a big way, but we clearly see that at some point of time they'll come back. Of course, markets are not dirt cheap. That I'll have to keep reiterating. And that is the only challenge at this point of time in the market. A lot of people who worry about earnings. If you look at the quarter which went by, bank earnings was fine, IT earnings was fine. There are earnings which were very bad, like some of the oil marketing companies. So those earnings have actually brought down the aggregate significantly. But I don't think those are the sectors which we really need to worry about. Some of the sectors get confused because, if you have a quarter where monsoon has been fantastic, economic activity gets affected in the negative. Last year in August, September, monsoon was very weak. So construction could resume. This year, monsoon was very strong. So construction could not resume. And in this entire September, October phase, when the sales in the festive season happen is very complicated. So I don't really worry about earnings. And when you have an election year and the government gets formed in May, really it's only after the Maharashtra election that you're going to press the button on all capex projects. And that was our belief. And that is why we did not worry when we thought of the fund launch as to what is going to happen to earnings and things like that. So this is the framework at this point of time. Where are we worried about? We are worried about small cap. We are worried about mid cap. If you look at how we think about them, we always look at price to earnings. Many of the small cap and mid cap have very high price to earnings. We are also worried about the fact that most IPOs go through of companies, including companies which are very weak. And I don't know whether company people understand what is there in those IPOs. And, it's really worrying because at the end of the day, if investors lose money in IPOs, they may lose faith in the equity market. This is something which we worry about. Will it happen in the next 3 months? I don't know. But I would say that, that is why I believe that of all the areas, I would say mutual funds are safer because at the end of the day, we look at hybrid funds as a entire framework. So as an AMC, most of you are invested with us who are on the call. Our goal is very clear. Our goal is not maximum total return. So if you look at funds where I've been a fund manager like India Opportunities or something like that, when market valuations went very high and we couldn't find special situations, we actually increased cash in the fund. So I have a value fund like Discovery. Again, in that fund, actually we increased cash in the fund. If you had looked at the portfolios in August, September, so, because frankly, if you ask me at some points of time, what happens is that if you don't find a very good idea, sometimes it makes sense to have cash. And that is the framework which we have believed in. And that is the framework under which we look at. So, if you look at even the NFO that we launched, which was the Energy Opportunities Fund, within the ambit of whatever we can do, we have tried to run the fund as we can, and that has been the way we think. So broadly, this is how we think, and we believe that if the market goes sky high, our goal and valuation becomes sky high, we will not participate in certain things. Now, if that is the framework we believe in, because we think, that kind of a framework is what actually works in the long run. Because what we saw in earlier cycles also, that if you go back to the 2017 cycle, in 2017, small and mid caps did extremely badly, well, against large caps. So at that point of time, we had seen that in value discovery, we had taken a call against small and mid cap. So people used to ask us, why are you anti small and mid cap? We used to tell them we are anti small and mid cap because the fund has because value small and mid cap doesn't look like value against large cap. Eventually, value discovery benefited out of having lower small and mid cap. In 2020, quality stocks used to be extremely costly compared to non-quality, and therefore we used to be negative on quality stocks. Frankly, at this point of time, quality stocks are very cheap relative to most things. So in 2020, we used to be extremely positive on many of the value stocks in the market. Whereas as we go forward, we are much more positive on quality stocks because the quality stocks have underperformed in the last 3 to 4 years significantly against value stocks. So for us, what we look at is valuations, and we are not concerned about whether we are pro quality, pro value, pro growth. Because finally, at the end of the day, when we are investing, we have to think whether something is relatively reasonable or not. So today, at this point of time, after a 4-year underperformance of quality against value, some of the quality stocks that we used to actually detest in 2020 have become much more reasonable in 2024. Some of the value stocks which we used to really like in 2020 are no longer deep value at this point of time. So this is the framework we have. Now, clearly, of course, in the case of small and mid cap, you could tell us that we've been wrong because for the last 2 years, we've been cautious and they've continuously gone up. And that I believe is just like, if you have a situation where on a continuing basis selling happens and all the selling is from FIS and FIS sell only mega cap, what happens is the more and more small and mid cap becomes overvalued. But that is not the reason. So that doesn't worry us, the fact that small and mid cap has continued to outperformance. Because the real reason for small and mid cap outperformance has been the fact that small and mid caps have not been sold by FIS. In normal market corrections in the last 15 years, the sector which used to lead market corrections used to be banking. If you look at the last 30 to 45 days, banking was not the sector which led the market correction. Now you'll ask me why? Because what happened was over the last 2 years, actually, FIs had kept on selling banking. And with the impending changes in weightage in banking in the FII benchmark, no longer are FIs overweight banking, overweight banking. Consequently, what happened is in this cycle where actually where markets corrected, banks did not do that badly. Some of the NBFCs did badly, but not the banks. Because what happens is when you would always think that banks being leveraged instruments will always do badly in any correction. But if you look at the 30 to 45 days, some of the leading banks did not underperform the market. So I believe, there are the advantage about investing, and it makes the job very interesting, is that one rule doesn't work all the time. If you go back to 2008, go back to 2011, go back to 2020, you will find that all market correction used to be led by banks. Whereas this time, banks are not the sector which has led any market correction at this point of time. So you have to look at valuations, you have to look at where you are in the cycle, you have to look at sentiment. That today, if you look at banks, no longer are the foreign institutions or the domestic investors very overweight banks at this point of time, and that is the reason why this has happened. So that's the interesting aspect. So what should one do at this point of time? Our view is that small and mid cap looks overvalued. When will it work? Requires selling. Till selling happens, it can continue to do well. People ask us to forecast timing. It didn't work. We used to think that a trigger can happen due to various reasons. It can happen due to those things did not work as trigger. But around the US election, the market corrected. Now, could we have predicted the trigger? The answer is no. So, like that, can we predict the trigger which will result in small and mid cap underperformance? The answer is no. In this whole lesson, in 2011, 12, 13, people used to tell us, I'll only invest in real estate. But we could never predict that the trigger for real estate underperformance was an interest rate hike in 2013 August. And after that, real estate did not work till 2020 when they actually started giving teaser loans in housing loans. So I believe like that, it's very tough to predict, but clearly small and mid cap is overvalued at this point of time. Large cap on sentiment basis is very attractive. On valuation basis is moderately attractive, not very attractive. So this is where we are. So I would say asset allocation remains one of the most interesting areas. So we have interesting categories, whether it is the equity savings category, whether we have the balanced advantage category, whether we have the multi-asset category, whether we have the equity and debt category. We have multiple categories which are interesting at this point of time. And I would say that we are in a very interesting period. One way market just going up every month is not the easiest thing for a fund manager, because a lot of mistakes then happen. A lot of investors also make mistakes because they violate all rules on asset allocation. So I believe the recent spell of volatility has forced people to rethink what is their assessment of risk, where do they stand in the equity market cycle. But I still believe most of the errors will be committed in the derivative segment in direct equity, not on the mutual fund space. And within mutual funds also, the areas that we have been talking about, like asset allocation, or the new category, that new fund launch that we are doing, minimum variance, which is focused on defensive large caps alone, are all much safer than most of the other categories. Of course, on the riskometer side, I'm sure minimum variance will come out as a risk, which is as a high risk fund, but it will be focused on the defensive areas, and that is how we'll look at it. And this broadly what I wanted to convey. Happy to take up questions at this point of time, and we'll be happy to answer those questions.
Thank you, Naren. Thank you for your entire market outlook. Naren, at this point of time, we are also getting some questions which are common questions of investors. What we see at this point of time, there are various global factors which are playing across the world, and we just wanted to know how they are going to affect Indian equities, whether it is geopolitical issues or there is noise around China, Japan, and etc. We have talked about US. How are the global scenario going to affect India in the coming months?
See, China issue has never affected India because many of the people who actually exited China invested in India. And off late, there are a lot of people who thought that people are selling India to buy China. No, China has done very badly. So I don't think it has happened that people have taken out money from India to put it in China or something like that. So I don't think China geopolitically is a real problem from a market perspective point of view. I think it is only US with their dollar strengthening has been a challenge, and US market doing so well has been a challenge. And I don't think so. That's why that is not a, of course, the way the entire Ukraine-Russia war continues and the way the Israel-Gaza issue moves, it can all have an impact. And, so far that impact has been lower than what I would have imagined. It can always flare up. These are areas on which what do we at ICICI know more than most people? That's a question I keep asking. That is the reason why we recommend asset allocation, because frankly, our ability to judge geopolitical events is very poor. I don't think any of us could guess that Ukraine and Russia would go to war, or in Gaza there would be so much of conflagration problems. None of us correctly guessed it. That's the way I look at it.
Naren, how do you also see the interest rate scenario playing out from here? People were expecting rate cuts. Were also expecting huge rate cuts into US scenario. What is your take on interest rates?
My colleague Manish believes that till the big rate cuts are not on, till you know what Trump's economic agenda is. So today the Treasury Secretary has been appointed. So let's see what he's going to do after he comes there. But if he's going to increase tariffs significantly and cut taxes significantly, the chances of big rate cuts seem off the table to me.
Okay. You talked about how sentiments play a significant role in making decisions. What is your advice to the investors at this point of time, looking at the sentiments? How should investor look into their own sentiments while investing?
See, they have to look at their asset allocation. They have to look at what is the capability to take risk. And then they have to assess their sentiment. Suppose their asset allocation is telling them that they are very underinvested, and then it's different. And their ability to take risk is very high because they are very young and their income is much higher than their asset base. And therefore they can afford to take risk. Then it's a different situation. On the other hand, if you are an 80-year-old whose income is zero and you're living off your assets, then you have to act differently. So there is no one size model that I can give people, and it'll work wrongly because it would depend on how much is your income, how much is your asset, how large is your income relative to asset, how much is your expenditure relative to your asset, and what are your obligations to your family and otherwise. There are so many complications which based on which you have to take these decisions.
Thanks, Naren. Naren, we have successfully managed so many NFOs in the last few years. Still, there is a question that is coming on why one should invest into an NFO. What is the advantage of putting money during an NFO?
See, the way I looked at it, in 2017-18, we launched Value 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, etc. And people used to trouble me a lot saying, what are you doing? You're doing it. Why are you doing this? My view is, I went to a model where I asked people, one of my gurus called James Montier says there has to be a little bit more unconstrained. Suppose you give me money, let's say in blue chip. No, blue chip as a peer group. Now that peer group is settled for years. And my colleague Anish, if he delivers bad returns against that peer group, he's penalized. So he doesn't have any constraint. He is constrained. Now, I run a multi-cap fund. If you give me multi-cap fund, every peer group has a multi-cap fund. Now, the point is that what happens is that you're constrained because at the end of the day, you are going to measure me against every multi-cap fund. When you give me money in a multi-cap fund, I am not going to take this thing. Whereas look at how many minimum variance funds are there in the market. So I'm very unconstrained because of that. And that's something I'm not able to put it across actually, because that is the main advantage that I have. That I am running, I run energy opportunities unconstrained, I run minimum variance unconstrained within the SID rules, within the SEBI rules, within everything which is allowed as per the regulation and as per the scheme information document. But still, I'm unconstrained because every day people ask me when I'm running the multi cap fund, have you done better than X multi cap fund? Whether you have done better than Y multi cap. So that becomes a big bottleneck on how to think. I'm always thinking, what are the others doing? I won't bother. I don't bother at all. I say, okay, market is like this, I'll do this, I'll do that. That's what I think. I'm only look at regulation when I'm running any NF, nothing else.
Thanks, Naren. Naren, what do you think, which type of investors should be looking forward to invest into this minimum variance fund?
Anyone who believes in negative return should not invest. Anyone who believes in big return should not invest. These two I'm clear. So I believe that these are the two from their point of view. Our view is that given that it is a nifty stock fund, anyone who is under invested in large caps should invest. And anyone who believes more in large caps today should invest. Anyone who believes in a moderate return situation but likes equity as such as an asset class should invest. This is what I can think of.
Naren, one final question. There has been a constant debate on active versus passive. What do you think active versus passive is a situation compared to the minimum variance fund, NFO?
This is the most interesting thing that makes my colleague Vaibhav most happy. So if you look at it, although the name is different, but we have a good amount of AUM in our low vol ETF. So although the benchmark is nifty, the goal, the secondary, I've given Vaibhav the job. He has to show that active is better than passive. So that is the thing. See, you know how passive is. Passive changes once in a way only that entire weightage. The weightage is also, I think, in that fund everywhere 3 to 5%. They've got in different stocks. No stock is more than 5%, and virtually no stock is 1%. So it's a job. It's very interesting to see how this fund does against that, and that is the most interesting thing for me. See, as a job, the advantage is that today, unlike when I joined ICICI Mutual Fund in 2004, the index and ETF is always there at the back and always there to think how we run against them. And that makes our job interesting, challenging, and on a continuing basis. But if people start looking at it on a daily basis or weekly basis, it is wrong. Because I remember a year like 2018 and 19, where people started questioning, what are you people doing in active fund management? I used to tell them, don't measure us in 2018 and 19. Wait, it worked finally. Like that, again, there'll be a period where people will say, what is this active? So, you have to take active risk and you have to do a lot of things. So it's going to be a job. It's going to be a job for Vaibhav, my colleague, who's the fund manager in this. Because there are passive strategies which are like minimum variance strategies and they have money.
Thanks, Naren. That concludes the last question. Thank you, everyone, for joining on this call. I'll just ask Naren to give his parting comments. Naren, over to you.
So our view has been that market is still not cheap. Doesn't mean market is going to correct now because there has been a meaningful correction. I don't think FIs are going to keep on selling. I think there'll be a period when FIs are going to buy. Domestically, there is no problem as far as Indian market is concerned, except that even today, after the correction, also Indian valuations are reasonable in large caps, overvalued in small cap and mid cap. That is the only challenge. And this strategy that we have launched, equity minimum variance fund, is one of the most interesting areas at this point of time. Provided you're not a big believer in mega returns, provided you're not a believer in negative returns. That is how we look at it. And every NFO that we launch, we take it very seriously. And that most of you know, because I think the people on this call have participated with us in different NFOs, and we've taken each of them seriously. And that is the framework under which we work. Look forward to a very happy 2025 and festive wishes to all of you and your family members. Thank you.
Thank you. Thank you, Naren. Thank you, everyone, for joining on this call. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.